Hello friends, in our previous lecture we have completed chapter number 7 cash flow. Now we will move towards the next chapter, that is also a type of subsidiary book, that is chapter number 8 journal proper. Now friends, as you know, we have started from the 6th chapter the topic of subsidiary books. Subsidiary books related to goods have been learned in chapter number 6, that purchase, sales, purchase return, sales return. After that we have learned in chapter number 7 cash book and different types. Now friends, as you are remembering that whenever we were preparing purchase book, and if there are some expenses which cannot be recorded in that book, then we were writing these expenses will be recorded in journal proper. So friends, journal proper means the transactions which are not recorded in any other type of subsidiary books are recorded here. So journal proper is also a type of subsidiary book, and this format of journal proper is same as journal entry. What is the difference between journal entry and journal proper? In journal entry all the transactions are recorded, and the journal proper, the transactions which are not recorded in subsidiary books are recorded here. Suppose if we are not maintaining purchase and sales return book, purchase returns and sales return book, we are only maintaining purchase book and sales book, then the remaining purchase return and sales return transactions we can record here. In the same way, if we are not maintaining the bank column in cash book, then we can write all the bank transactions in journal proper also. So as per the information given in question, we can write this thing. Okay, now we are starting. So this chapter is easy, okay, nothing, little bit new points will come. We studied different subsidiary books in chapter of subsidiary books. Journal proper is also a type of subsidiary book. Journal proper is kept in order to record those transactions which cannot be recorded in purchase book, sales book, purchase returns book, sales return book, cash book, petty cash book, bills receivable book, bills payable book. For example, furniture sold to Parthiv for 5,000. This transaction is credit sale of furniture which cannot be recorded in any of the subsidiary book, and hence such business transactions are recorded in journal proper, which is a part of subsidiary books. Meaning of journal proper: the subsidiary book in which the transactions which are not recorded in any other subsidiary book are recorded is known as journal proper. Please underline the meaning of journal proper. The meaning is the subsidiary book in which the transactions which are not recorded in any other subsidiary book are recorded is known as a journal proper. Journal proper is used for very limited number of transactions. The format of journal proper is same as the format prepared to record the journal entries. It has 5 columns, that is date, particulars, LF, debit and credit. So you can see the format. Transactions recorded in journal proper. We have seen that transactions which cannot be recorded in any other subsidiary book are recorded in journal proper. See, the format is same as journal entry, only nothing new. Now we are seeing which are the transactions to be recorded in journal proper. Opening entries, transactions not included in any other book, transactions of inter-account transfer, closing entries, adjustment entries, rectification entries. So there are so much type of entries which are not recorded in any other subsidiary book are recorded here. And in that we are going to see first type of transaction, that is opening entries, means to start the business. When a person start his business, he bring his personal assets into business, which is recorded in journal proper. Now you look the example and understand the difference. Example: while starting the business, Virendra brought in cash of 15,000, furniture 10,000, stock of goods 8,000, debtors 3,000 and creditors 5,000 in the business. Now we know very well this entry, that what we are bringing in debit except the creditors, because creditors is our liability. So the entry, normal entry would be cash debit, furniture debit, stock debit, debtors debit, creditors credit, and remaining should be the creditors, and remaining should be in the capital account. But see the difference, what entry is passed here: furniture account debit, goods account debit, debtors account debit, creditors account credit, capital account credit. But where this is cash, where this cash is recorded? Now that cash is recorded in cash book. See, one note is given. Cash brought 15,000 is cash 15,000 brought in while starting the business will be recorded in journal, will not be recorded in journal proper, as it is recorded in cash book only. Previous chapter we learned what is cash book, to record all the cash transaction. Now cash is coming in through the owner, so on debit side we have written to capital account. So we are not writing this. So you have to understand the difference, my friends. If journal entry is to be passed, then including cash everything is is passed. But if journal proper have to prepare, then cash transactions are not included here. Still, if they are telling only, then only we have to write. Otherwise, cash transactions are not recorded in journal proper because we have cash book for it. So the transactions which are not recorded here are recorded only here. So we will see its sum. So first you write the name of chapter. Chapter number 8. Journal proper. And we have one sum for this opening entry, so we are doing that sum. Nothing, no notes are actually required here, okay? Because all the things we have learned and we have to just pass them. So on page number 198 you can see question number 4. That is regarding opening entries. Dhrumil Kamani starts business with following assets and liabilities date 1/1/15. Write opening journal proper, underline. So opening journal proper of Shri Dhrumil Kamani. Date, particulars, LF, debit rupees, credit rupees. Now we are taking the question. Cash 18,000, bank 12,000, furniture 15,000, stock 20,000, personal debtors 5,000, 12% loan from Mayabin 10,000, and record cash and bank transaction in cash book only. Now what entries will be passed? Please see, then I will explain. Date is 1/1/15. Furniture account debit. Stock of goods account debit. Debtors account debit to capital account. 15,000 for furniture, 20,000 for goods, 5,000 for debtors, and 40,000 for capital. B. Started business by bringing furniture, goods, and debtors. Total 40,000, 40,000. Now a note. Cash, bank, and loan of Mayabin will be recorded in cash book. Still many of you have doubt. You all have understood that in columnar cash book we are having cash and bank column, so related transactions are recorded. Then why we are not recorded loan here? Now you think of the journal entry for loan. What is the entry for loan when we are taking the loan? Cash account debit to loan account. So in that also cash is coming. So normally these loan transactions are also not recorded. If there are creditors we would have recorded, but this is a loan. So friends, cash transaction in cash book, bank transaction in cash book, when the transaction of taking the loan or from loan cash is coming in, so it is also related to cash, that will be recorded in cash book and remaining things are only recorded here. So this is the basic difference between a journal proper and a journal entry, because here only that transactions are recorded which cannot come in any other book. Okay, now we are seeing the next topic in the chapter. Opening entry is over. Now let's go for the next topic. Okay, it is given on page number 192. Transactions not included in any other books. They are of 2-3 types. Those transactions which cannot be included in any other subsidiary book are included in journal proper. Such transaction can be divided into 3 categories. Which are they? A. Credit purchase or credit sale of asset and profit or loss on its sale. Sometimes, if the assets are also sold on credit or purchased on credit, then their entry cannot be made in purchase book, sales return, purchase return or cash book. So we have to make in journal proper. And sometimes, if we are selling the asset or purchasing the asset on cash, but sometimes we are getting profit or incurring loss on that, so that profit or loss which have been incurred on asset sales cannot be recorded anywhere, so we are recording here. When asset is purchased or sold for cash, it is recorded in cash book. But if asset is purchased or sold on credit and its profit and loss or sale can be recorded in journal proper, they cannot be recorded in other subsidiary book. On page number 193, transactions for which subsidiary books are not kept. The transaction for which subsidiary books are also not kept are also recorded here. Which are they? Many a times when the proportion of certain type of transactions are very less, a separate subsidiary book is not kept for them. Such transactions are recorded in journal proper. Example, all traders do not keep subsidiary books for recording the transaction of bills, that is bills receivable and bills payable. In such a situation, transactions of bills are recorded in journal proper. At times, some traders do not keep returns book, that is purchase returns and sales return book. In such a situation, transactions of purchase returns or sales return are also recorded in journal proper. See friends, we have subsidiary books for bills payable and bills receivable. Still, if the transactions are very less, it is not necessary to prepare that book separately. So all these transactions are again included in journal proper. Also, all the traders do not maintain the purchase and sales return book also, because normally they are not returning if once they are purchasing or once they are selling the goods. So again, if very less chances of purchase and sales return, so they will not maintain separate books, they will record it here itself. Okay, next C, on next page C, page number 194 C. Special transactions not recorded in other subsidiary. Which are that special transactions? Some special transactions are not recorded in any other subsidiary book, so they are recorded in journal proper. Example, goods given in charity, goods given as samples, goods taken for personal use, dishonor of bill means rejection of bill, bad debts, endorsement of bills receivable, loss of goods due to fire, accident, theft, depreciation. All these are transactions cannot be recorded in any other books. These are some outward of goods, so they are also to be recorded in journal proper. Okay. And on page number 195, one more thing. Transactions of inter-account transfer means endorsement. From one you have to receive and one you have to pay. So one will be debited, one will be credited. So that is inter-account transfer. Sometimes due to some reasons the amount is transferred from one account to another account, either partially or fully. Such transfer is also recorded in journal proper. In the same way, account can be closed at the end of year and transferred to another account. The transfer entry is also passed in journal proper. So now we are seeing the sums for all these types. That is 5th sum and 6th sum on page number 199. So now I am reading sum number 5. Sri Gujarat Stores does not maintain which books? So the Gujarat Stores, if not maintaining that books, then that transaction will be recorded here. Separate books for transactions for bills receivable, bills payable, purchase return, sales return. Record the transaction in journal proper. Okay, so we are preparing the journal proper of Gujarat Stores. Question number 5. journal proper of Shri Gujarat Stores. Date, particulars, LF, debit rupees, credit rupees. Now friends, we will come across some of the new transactions. Transactions for these bills receivable and bills payable have not been seen in previous any other journal entry. So first I will give some central idea about them. Now see friends, bills receivable means here whenever we are drawing the bill on any person for receiving the amount is not received, still amount is receivable. So how to write the entry for bills receivable when we are drawing the bill? As we have to receive the amount from them in future, it is receivable, so bills receivable account will be debited and that person's account will be credited because he will be giver in the future. And in opposite, if we have accepted some other bills, if some persons are writing the bill on us and we are accepting that bill, then that is our bills payable. If we are writing the bill, that is bills receivable. If we are accepting the bill, then that is bills payable. So we are accepting that person's bill and that person is the receiver in the future of our amount. So that person's account will be debited and bills payable will be credited. See, both have opposite entries. For bills receivable to person, and for bills payable, person to bills payable. And opposite entry for payment. If we are receiving the money from bills payable, so cash is received, cash debit and bills receivable credit. If we are paying the money for bills payable, so bills payable debit and cash will be credit. So this is the simple logic. Now we are seeing that logic here. Drew a bill of 8,000 on Ramnik which he accepted and written. We are writing the bill because we have to receive the amount from Ramnik in future. So we are writing the bill. It is bills receivable for us. So bills receivable will be debited and Ramnik will be giver in the future. So Ramnik will be credited. So number one, dates are not given. Bills receivable account debit to Ramnik account. Amount 8,000. B. Bills drawn on Ramnik. Okay. Accepted a bill of 3,000 drawn by Vijay. We are Gujarat Stores and Vijay is drawing on us, so we are accepting, so it is bills payable for us. So Vijay is drawing for us, Vijay will be the receiver in future. So Vijay will be debited and we will be credited, and bills payable will be credited. Vijay account debit to bills payable account. As you know, all payables are credit or receivables are debit. This is as per the previous rules of journal entry only. Okay, nothing we are doing new. B. Bills accepted of Vijay. Now you can see both the entries. When we are drawing or we are writing the bill, we are the writer, so it is bills receivable for us, so entry will be bills receivable to person. When we are accepting some other person's bill, we have to pay to them, so they are receivers, so they are debited and bills payables are credited. Okay, next entry. Bills receivable of Ramnik is endorsed to Ramesh. The amount of bill which we have to receive from Ramnik, now we are endorsing, we are giving to Ramesh. So Ramesh is the receiver and our our bills are going. So Ramesh account debit, bills receivable account credit. Ramesh is the receiver of that bill. Instead we will receive from Ramnik, that bills are to be given to Ramesh. So Ramesh account debit to bills receivable account. Suppose if bills are not endorsed and bills are cash is received for that bill, then cash to bills receivable. But here we are giving the bills to Ramesh. Instead we are not taking the cash, we are giving that bill. So this is the process like this. See A, B, C. We are B. We have received the cash from Ramnik and then we have to pay to Ramesh. Instead directly we can give to Ramesh. This is also possible. Okay. So the amount which was receivable from Ramnik we have transferred to Ramesh. So now they will settle their amount. And the amount will be 8,000 because amount is not given in the question. So the amount of previous bill is to be taken. B. Bill of, and if it is again dishonored like check, then opposite entry will be made, being bill of Ramnik endorsed to Ramesh. Amount from first transaction number 4. Goods of 3,000 returned by Paresh to us. Now first you have to decide whether this is purchase return or sales return. Goods of 3,000 returned by Paresh to us. So we are receiving back the goods which we have sold. So goods are received back as sales return. So sales return will be debited. Paresh was the giver. So Paresh is to be credited. Understand, he is giving back to us. So we are receiving because we have sold to him. Now he is returning back. So sales returns account debit to Paresh account. Paresh is the giver. Why we are recording it here? Because in the heading itself it is clearly given that transactions related to bill and transactions related to goods return, we are not maintaining subsidiary book, so we are recording it here. Being goods returned by Paresh. Fifth, last transaction. Goods of 1,500 returned to Mahendra. Now we are returning the goods to Mahendra. Mahendra will receive and our goods will go because we have purchased from us. Now we are returning. When we will return the goods? When we have purchased, now we are returning. So Mahesh will be the receiver. So Mahesh will be debited and purchase returns will be credited. See here, nowhere it is given it is purchase return or it is sales return. But according to the words, you can identify which is purchase returns and which is sales return. Here Paresh is returning to us the goods sold. They are not telling that goods are sold. Paresh is returning to us, so it is sales return. We are returning to Mahesh, it is purchase returns. Being goods returned to Mahesh. Transactions are over. I am not taking both sides because on the both sides same amount is written 23,500. Next sum. So today we will complete 4, 5, 6. Fourth sum is completed, fifth sum is completed. Now we are going for sixth sum. After for tomorrow 7, 8 and 9. So tomorrow this chapter will also be over. Okay. Sixth sum. Record the following transactions in journal proper of Rakesh. Okay. So we will make journal proper of Rakesh. Question number 6. Journal proper of Rakesh. Date, particulars, LF, rupees credit rupees. Now the transactions are very easy. Okay? Give goods of 5,000 to Anathas. We are donating the goods. So goods are going out other than sales. That is goods given as donation, charity, personal use or by fire. So for all that transactions always purchase is credited and donation or charity is debited. All these transactions now are taken. Okay. Only these bills transactions were new. Now the transactions which are given are all we have repeated in that journal entry chapter. Okay. So, donation or charity account debit, and as goods are going out other than sales, so purchase account will be credited. Goods are of 5,000. B. Goods given at Anath Ashram. Second, distributed goods of 4,000 as free samples. We are giving the goods as free samples. So it is advertisement for us, and as goods are going out other than sales, purchase will be credited. So advertisement expense account debit to purchase account. Goods are of rupees 4,000. Because we are giving the goods, goods are going out and we are giving as free samples, so it is our advertisement. B. Goods given as free samples. Next, number 3. Withdrew goods of 8,000 from business for personal use. So again goods are going out other than sales, purchase is credited and we are giving for personal use, so drawings is to be debited. So drawings account debit to purchase account. Amount 8,000. B. Goods withdrawn for personal use. Purchased a furniture of 3,000 by giving goods of 2,800. So we are purchasing asset is coming in and our goods are going out. So again goods are going out other than sales. So purchase is credited, furniture is purchased, asset is coming in, so furniture will be debited and goods are going out other than sales, so purchase will be credited. Now for furniture it is 3,000 and for goods it is 2,800, so always we should take the amount of goods only. Okay, in third chapter also I have said this thing. So furniture account debit to purchase account 2,800. Always take the amount of goods only. B. Furniture purchased by giving goods, and in bracket take the amount of goods always. Whether it is more or less, always we should take the amounts of goods only, remember. Now again one more outward of goods. Goods of 7,000 are destroyed by fire. Insurance company accepted a claim of 55. Also we have same transaction in third chapter only. Now again goods are going out other than sales, goods are going out by fire, so purchase will be credited for 7,000 goods amount. Insurance company is giving us 5,500, so insurance will be debited. Now the difference of this 7,000 and this 5,500, that is our loss, so loss also will be debited. So insurance company account debit, loss due to fire account debit to purchase account. Now see, most of us know to write the journal entry but don't know to write them out. Goods are going for 7,000, so credit side it will be 7,000. Insurance company is giving us 5,500, so in insurance company 5,500. Now 7,000 credit minus 5,500 debit, so our loss will be 1,500. Okay, in that way you have to do. B, goods destroyed by fire and insurance company accepted the claim. Number 6. An amount of 2,000 receivable from Nirali which cannot be received now. Actually we have to receive the amount, but she is not giving. So it is our loss, and this loss is like a bad debt. Now for this you require the concept of first chapter also. When an amount is receivable from a person, and by making so much efforts, if that amount is not receivable, then it is our bad debts. Bad debts is loss, it will be debited. And that loss giver was the Nirali, so Nirali is to be credited. So bad debts account debit to Nirali account. So much things we are learning new in this chapter 2000. But these all things are actually repetition, okay? New things are there, but these are only repetition from previous chapters. Being amount receivable from Nirali cannot be received now. Number 7. Write-off depreciation on machinery 800. Depreciation is a loss or expense, so it will be debited. Now they are calculated on assets only, that asset is to be credited. See, this entry has not come in previous chapter, so I am explaining the concept. From first chapter, from our terminologies, you can see that depreciation is the expense or it is the loss by decreasing the value of assets. So it is to be debited, and the assets on which it is calculated should be credited. So this entry is very easy. Depreciation account debit to machinery account. Why depreciation is debited? Because it is a type of expense or loss, and due to this machines or assets value is decreasing, so we are writing on credit side rupees 800. Or else we can know that depreciation is calculated on machinery. So depreciation debit, and on which it is credited should be credit. Being depreciation written off. Written off means considered. Written off means considered or calculated on machinery. Last, number 8. Salary of 1 month of March is unpaid. Now this we have learned in chapter number 5. A is equals to C plus L. Salary is our expense, so salary is debited. Now it is unpaid, means it is outstanding, and the name is also not given. If suppose salary is unpaid to Rakesh, then salary account debited, Rakesh will be credited, because if salary is paid, salary to cash. If salary is unpaid, salary to Rakesh if name is given. Now if name is also not given, what entry we can write? Salary debit and salary outstanding should be credited, because no name is given. We have learned this concept in chapter number 5. Salary account debit. You can see the same concepts there. Outstanding salary account. Amount is 7,800. B, salary unpaid of March. Total. 5,000, 4,000, 8,000, 2,800, 5,500, 1,500, 2,000, 800, 7,800, 37,400. One more time, I have not rubbed this and that thing, we will repeat. And before that also for fourth question, again I will repeat. We are starting the business with cash, bank, debtors, furniture, goods. But why we have not recorded cash, bank and that loan? Because the transactions, that note is also given in question number 4. The transactions related to cash and bank are recorded in cash book, so they are not required to record here. So we have recorded only furniture, goods and debtors and to capital. Because the transaction of cash, bank and the transaction of loan is also a cash transaction, it is recorded in cash book. Now we have starting again for fifth question. Again we are repeating all these things. Drew a bill of 8,000 or rounding which he accepted and written. We are drawing the bill, so it is bills receivable for us and it is received from some other person, so they are our giver. So bills receivable will be debit and that person who is the giver should be credit. Accepted a bill of 3,000 drawn by Vijay and written to him. Now we are accepting some other person's bill, so it is our bills payable. So we that other person will be the receiver and we are the bills giver. So Vijay account debit and bills payable account credit. If we are writing the bill, bills receivable. If we are accepting the bill, it is bills payable. Now if we are receiving the cash from bills receivable, cash to bills receivable, and the same bill if we are endorsing, then cash is not received to us, cash is received to that person. So Ramesh is the receiver of that bill and bills receivable is credit. Means here we are endorsing that bill. Third question, we are endorsing the bill of running to Ramesh. Now fourth, goods of 3,000 written by Paresh to us. Paresh is returning the goods which were sold, so sales returned to Paresh. We are returning the goods to Mahendra, means Mahendra is the receiver and purchase returns will be credited. Now on sixth sum, gave goods of 5,000 to Anathas. We are donating the goods and goods are going out other than sales, so donation or charity account debit as it is an expense or loss, or purchase account should be credited. Distributed goods as free samples. As we are distributed goods as free samples, goods are going out other than sales and people are getting the goods, people are advertising. We are advertising our goods. So advertisement expense account debit to purchase account. Now we are withdrawing the goods for personal use. So again goods are going out other than sales, purchase will be credited and drawings will be debited because it is personal use. So drawings to purchase. Purchase furniture by giving goods of 2,800. Now we are purchasing an asset, that is furniture. Furniture comes in, so furniture debit. We are giving the goods, so purchase account will be credited and the amount will be written for goods only. Goods of 7,000 destroyed by fire. Insurance company accepted a claim of 55. Goods are going out by fire other than sales, so purchase credit. Insurance company is giving the amount, so insurance company debit, and the difference of 7,000 and 5,500 is not received, so that is our loss, it is to be debited. So insurance company debit, loss debit, purchase credit. Amount of 2,000 receivable from Nirali is not received. We have to receive but we are not receiving, so it is our bad debt, so bad debts account debit and the giver of that bad debts are Nirali, so bad debts to Nirali. Right of depreciation on machinery. Depreciation is the expense and to which asset it is written it is to be credited, so depreciation will be debited and the asset on which it is calculated is credited, so depreciation account debit to machinery account. And last, salary of 1 month is unpaid. To whom it is unpaid it is not given, so salary is an expense, it is to be debited. To whom it is not given, so simply we can write salary outstanding as it is payable for us in future. So friends, today we have completed sum number 4, 5 and 6. Tomorrow we will complete number 7, 8 and 9, so that our chapter will be completed and we will go for the next chapter. After that we will remain only with 2 chapters. So that's all for today. Thank you so much.